Hey everyone, and welcome back to our Retirement Masterclass series. This is going to be part 7, all about insurance and how you can use it as a secret hedge for your portfolio. If you've missed any of the previous parts of this Masterclass series, we actually have a link in the video description below the video so you can go back and check out any of the previous episodes in the playlist. In part 6 of the series, we covered the 3 main asset classes. We talked about how to choose between them and why it is so important to rebalance your portfolio as you age. Insurance. That single word can make even the savviest investor roll their eyes. Yet, when you understand its power, it can become a strategic asset. One that safeguards your financial journey against all of life's curveballs. Today, we're going to unpack insurance products, explain why you need them, show you the pros and the cons, and illustrate how they fit into a total portfolio as a true hedging tool. At its core, insurance transfers risk. You pay a premium today so that if something unexpected happens tomorrow, whether it's a serious illness, a lawsuit, a house fire, or anything else, you're not left absorbing a catastrophic cost all alone. It's risk management, plain and simple. When it comes to insurance, there are 5 major categories that we're going to cover. Those would be life insurance, disability income insurance, health insurance, property and casualty insurance, and long-term care insurance. Each has its own role, and we're going to break them all down for you today. The question of life insurance usually comes down to term versus permanent. Term life insurance gives you high coverage at low cost for a fixed period, say 20 years. It's perfect for covering a mortgage or your children's education. Permanent policies, such as whole life or universal life, build cash value that you can tap into or borrow against. They're pricier, but double as an investment vehicle. Your greatest asset is your ability to earn an income. If an injury or illness sidelines you, disability insurance replaces a portion of your paycheck. It's typically around 60 to 70%. Locking in a policy can give you peace of mind if something catastrophic ever strikes. Health coverage takes center stage after skyrocketing medical costs. As many people know, plans can vary by deductible, network, and premium. Someone who's young and healthy might choose a higher deductible plan to save on premiums, while a pre-retiree around age 55 might favor a richer benefit design as medical needs grow. As with many things, your coverage will shift with changes in your life. Property and casualty insurance, known as P&C, often includes homeowners, renters, auto, and umbrella liability policies that protect your physical assets and shield you from things like lawsuits. Many of these policies can often be bundled to save on premiums and lock in broader coverage. As we live longer, the risk of needing chronic care increases. Long-term care insurance reimburses home care, assisted living, or nursing facility costs. Unfortunately, this particular type of insurance often goes overlooked until it's too late. Even at age 55, somebody can still purchase a plan with affordable premiums, but if you wait till you're 68 or 70 years old, the costs can jump dramatically. So after hearing all that, you might ask yourself, why bother? Well, insurance isn't a line item expense. It's actually a hedge against tail risk. Instead of hoping nothing bad happens, you shift the financial fallout to the insurer. It smooths your net worth trajectory so that a single event doesn't derail decades of hard work and investing. So now let's cover the pros and cons of insurance, starting with the pros. It provides peace of mind. It can give income protection. It serves as a tail risk hedge, and in the case of permanent life policies, as a potential cash value grower. So then what are the cons? Well, premiums can reduce your cash flow. There is a lot of complexity, especially in policy choice for certain categories, and surrender charges or harsh underwriting can be an obstacle that is hard to overcome. Understanding the trade-offs ensures that you pick policies that align with your goals and with your budget to make sure you're protected, without eating up all of your money and leaving you unable to still invest and grow wealth. Now let's tie insurance into the total investment portfolio context. Investments will grow your wealth, but they cannot replace lost earning power or cover catastrophic liabilities. Think of insurance as a non-correlated asset. When the markets take a downturn, an unexpected disability claim or a fire claim isn't correlated to stock prices. You still get your benefit. In portfolio theory, true diversification includes protection against ruin. Stocks, bonds, real estate, they all zig and zag together. Insurance fills the gaps by kicking in cash when you need it most. That's hedging with policy contracts, not exotic derivatives or any other crazy option. If you're a young single in your 20s or 30s, you'll look for things like a high deductible health plan, some disability insurance, and maybe renters or condo insurance. For those in their 30s to mid 40s, you'll look for things like a 20 or 30-year term life policy to cover income and mortgage. You'll look for an umbrella liability policy, and you might consider starting a small whole life policy for your children's legacy. For those pre-retirees in their 50s to 60s, they're going to maintain term life or convert to a permanent life policy. They're going to look for long-term care policies, as well as start to review their health coverage strategy to make sure that they have the right type of coverage for what they need. For those retirees age 65 plus, they're going to look for final expense life or a small whole life policy. They're going to make sure they have long-term care if not already in place. And they're going to start to review their homeowners and umbrella limits, especially if downsizing has occurred. Insurance finds its true power when you align it with the stages of life and weaving it into your portfolio. It's not one size fits all. It's dynamic, it's structured, and it should always be tailored to where you are on your financial journey. For investors who view insurance purely as a safety net, there is a next level play, portfolio level insurance. You can use structured solutions like our defined income and protection strategies that let you embed a custom hedge strategy directly into your investments. Here's how our DIP strategy works. You choose your downside strike or protection level, say 90% of your principal. Then you choose your tenor. It's often 3 months, 6 months, maybe a year. And you lock in a coupon that typically beats money market yields, CDs, or a high yield savings account. In a bull market, you capture a slice of the upside. In a bear market, you still get 100% of your invested principal back. It's like buying a one-off term life policy for your portfolio value, insuring against tail risk without bailing on growth. Let's take an example of an investor at age 55. They earmark 20% of their portfolio to a 5-year defined income note with 90% principal protection and 50% participation. If equities soar, they net a 10% gain on that slice. If they plunge 20%, they redeem at full face value with no haircut, all the while earning a juicy yield that outpaces traditional cash alternatives. Having a blend of principal safety, upside potential, and higher income makes portfolio insurance a powerful complement to all of the other insurances we talked about. It turns your market exposure into a smart asset, one designed to protect and to perform. Ready to write your own insurance story? Then find yourself a trusted partner that can help you take stock of your current policies, map them against your life stage, and consider where a hedge makes sense. If you're curious what that looks like for you in your unique situation, then let's chat. By leveling up your investment approach with a solid insurance strategy, you can take your retirement planning to the next level. We hope you enjoyed this video covering insurance and why it is the secret hedge for your portfolio. Coming up in part 8 of the series, we're going to do one final wrap up and we're going to bring everything we've talked about together. So stay tuned for that final part as we bring to a close this masterclass and set you out on the journey to building a stronger and more powerful retirement. We hope you enjoyed this video on insurance. It is actually one of many parts of our grander retirement masterclass series where we cover retirement from beginning to end to help you level up your retirement game. So if you did enjoy the video, be sure to drop a like as well as subscribe and hit that notification bell to stay updated whenever we put out a video, whether it's a part of this masterclass series or any of our other great content that helps you take your finances to the next level.